Well, hello everyone. The bell has rung. The trading week is over, and the only thing between you and a long weekend is me. So this is After the Close. My name is Barbara Armstrong. I'm a coach with Schwab, and today we're going to talk about investing with caution. We're going to talk about battening down the hatches because we have a lot of positions in our paper money portfolio. And when we have a market behaving as this market has behaved in the last month, do we stay or do we go? And if we stay, what do we do to protect ourselves? So these are the questions we are going to talk about today. We're also going to add a new position or two to our portfolio. But before we get started, I'd like to invite you to join me in the land of X. My handle, Barb Armstrong CS. And we also have the privilege of having Mike Fairborn with us. His handle is Mike Fairborn CS, and we're posting lots of great content that I think you'll find helpful. So if you haven't followed us there, be there, be square. And just before we get started, I want to remind you that everything that we discuss in this class is for information purposes only. It's not to be construed as a recommendation to trade any particular stock or strategy. And I just want to make that clear. We're using the Paper Money software application on the Thinkorswim desktop platform. It's a brilliant place to learn, to hone your skills, to make sure you have a plan in place, and then understand the methodology of how to place a trade using the Thinkorswim platform prior to trying it in a live account. We are going to talk about stop loss orders today, and just know that those don't guarantee that you're going to get out at a particular price. If the stock were to gap down, you could end up at a lower price than anticipated. Also, we're going to look at some covered calls and protective puts today, and know that, options do carry a high level of risk and aren't suitable for all investors. You have to meet certain requirements and apply for option trading privileges with Schwab, and not all will qualify. So let's get out to the platform and have a look. And just to clarify, if this is your first time in this class, the idea behind this class is, let's say you're working full time, you don't have time to look at the markets during the trading day. Let's say you're a physician, and if you're in surgery, you can't just be sneaking a peek at what's going on with the S&P 500. And your time to look at the markets is once the kids are in bed at 8 or 9 o'clock. But you want to be the master of your own destiny. You want to be able to make some decisions with respect to your own trading and investments, but you can't do it during the normal trading hours. And so that's kind of the premise of this. A lot of people are now looking at trading in the after hours. That isn't what this class is intended to do. And I just want to make that clear. If somebody has come here thinking we're going to be, trading after the regular market hours, that isn't our focus here. When we come and look at the S&P 500, and let's just look at a 6-month chart, since February 19th, this index has pulled back pretty dramatically. And we're definitely in correction territory. Let me just change my drawing tool. If we go from the low of this day a week or so ago on up, we were in bear market territory. And a lot of people are looking at this market now as being a bearish market, because we're still down even after today from that high. We're down almost 14%, over 13%. And, year to date, we're down 10.5. When we look at the NASDAQ, which is our tech heavy index, with no financials, we're down pretty significantly here too, 18%. And, certainly we were well over 20% when we hit this low. We were down almost 25.68%. So, this has, has created a lot of angst in the market. The conversations around tariffs, the on again, off again, now there's more. It's created a lot of uncertainty in the market. And, as we go into earnings season, which we're now in the middle of, it becomes harder for companies to forecast given their uncertainty with this new global tariff landscape, you know, if their business is international in scope, how tariffs might impact them in the coming months, and how it might impact demand for their products, and all of these things. So the market likes certainty, and there has been a lot of uncertainty in the markets in the last couple of months, and that's being reflected here. Now, I know that I have been an on again, off again host. I've been traveling a lot. You know, that will end for a little while at the end of April. I'll be here more consistently. But how have we done so far? Because we were pretending we had $1 million account, and we're sitting at 981,000. So we're down a little bit, but the NASDAQ is down almost 14%. And remember, the S&P is down over 10, and we're down about 1.8. So we would far rather be up. But given that there's been a bit of what I call benign neglect, because when, you know, I'm not teaching this class, I haven't been looking at this account. But, you know, we have put some things in place to try and protect ourselves. So let's look at a new opportunity, and then, you know, how we might, you know, invest with caution. So if we look at Dollar General, and there's been a lot of talk about demand destruction. You know, that's just a fancy term for saying people are going to stop buying stuff. And although the retail sales numbers, like how much stuff people bought, was strong in March, there was a lot of conversation around that being because of tariff angst, that people, if you're doing a home improvement product, you scuttled over to Home Depot, PDQ, or Lowe's, or whatever your favorite place, lumber yard, and you bought stuff ahead for your projects because of the concern of prices going up when tariffs come in. The same thing with cars. Car sales are up. But, you know, then that conversation is, well, are we just bringing demand forward into March, where somebody said, well, I was planning on buying a car in August, but I better buy it now because with all these tariffs, that car in August might cost me, you know, $3,000 to $8,000 more. And so it's not new demand or increased demand, you know, but there is some theorizing, and this is my theory, it might not be yours, that it's just drawing demand forward. And so we're kind of stealing from demand in the future because of this tariff concern. But when you look at a company like Dollar General, you know, this is inexpensive stuff. You know, and some might argue that you go into Dollar General and you're buying stuff you don't really need. Others might say, hey, need might drive up their demand, where people who might otherwise shop elsewhere might find themselves in a Dollar General, seeing if they can save a little. And this is a company, you know, that was on the struggle bus. You know, we see that, you know, it was up at $147, and it really dropped dramatically down to 66. But, you know, since we hit last September, it's been consolidating. And this pattern, and if you're new to technical analysis, you know, this pattern is called an inverted head and shoulders. Sorry, it's not exact. And then we had a breakout, and it came back to retest, and it's now moving up again. Now, I encourage you, if you're new to all of this technical analysis stuff, I teach a Getting Started with Technical Analysis on Tuesdays. And if you're missing your webcasts tomorrow, you might want to go and check a few of those out. But, you know, we've gone from 67 to 83. So that's about a 16-point move. And so some might say, well, a technician might say, well, then I'd look at this maybe going up to 99. And so if you wanted to do a short-term trade to take advantage of that, could you put in a target at 99? Well, sure we could. Or we could sell a covered call at 99 or 100. And then we could use the sale of the covered call to cover a protective put just in case this gets pulled down. And, you know, where might we sell our put? Well, we might say, buy our put for protection. We might say, hey, let's go, you know, at this maybe around the 85 mark or the 83 mark. So let's come to the trade tab and have a look. So if we come out to our trade tab and we say, well, if we sell, and you know, now we're in the after hours, so often the bid-ask spreads will get a little bit higher. But if we look at this will be calculated based on the average. And on Monday, when the market's open, we'd have to go in. But we're looking at selling a covered call. This would be buying covered stock. Okay. So if we're buying covered stock, we're buying 100 shares of the stock and we're selling a covered call. Okay. And we're going to do 2 of these, which would be close to a $20,000 position. And then we're going to come out and say, well, if we wanted to protect ourselves at around this $85 mark, we could then buy a protective put. And this is called a caller. So we're basically using the money from the sale of the call to purchase the protection of the put. And this, we may end up spending a little more on the put than we received on the call, but we're okay with that. Okay. So we are now going to come to single order, first trigger sequence, and we are going to click on the buy, and we're going to both buy shares of stock, sell a covered call, and buy the protective put. Okay. And we're going to come to confirm and send. So how much could we lose? Well, this is saying we could lose 18,438, but it's not taking into account the fact that we have bought these puts. And what does it mean when we buy a put? When we buy a put, it says if you would like to, it gives us the right to sell the stock at 85. And so we'd be down $7 a share, but we've, received the money from the call. And then we'd also be down the $1.35 that we spent. But then we know that no matter what, we're able to sell for 85. So we do have an opportunity up until May 16th to sell these shares at $85. Even if it went down to 75 or 60 or took a nosedive like UNH did today, if we had a protective put and it behaved similarly, we would still have the right to sell the stock at 85. So we're going to put this in our group with a caller. Now, is this a set it and forget it? It isn't, because tomorrow or Monday, we're closed, the markets are closed for the next 3 days, you'll want to double check and just make sure that we can get in at these prices. Okay. Now, if you're saying, well, I can't look at the market at all, during the trading day, you could put these in as market orders. That's your other choice. Now, have we done this strategy before? We have. And this is how you can place a new trade and put what we call a collar, which is, a cap on the top. So by selling the call, if it goes up to $100 and we're called out, we've sold our shares. We can't go, JK, I didn't really want to sell them. By selling a call, we're committing. We're saying, hey, if you'd like to buy these shares from us at $100, have at her. You're okay to do that. But, we'd be up $7 a share. That's over 7%. That's not too shabby, in 29 days. So we'd be willing to sell those shares. Okay. And if you're not, then don't sell the covered call. Okay. So what do we have in our portfolio now? Well, what we have is several caller positions. And I'm going to come back to these because what I want us to look at is our dividend stocks. And we have 4 stocks that pay a dividend. We can see here what the current dividend yield is. Now, one of the differences I want to point out between a paper money account and a live account is that dividends are not really paid in a paper money account. They are paid in a live account. The other thing I want to point out with dividends is just because they're being paid now, a company can change its mind and decide to no longer pay a dividend. And then that usually has a negative impact on the price of the stock. But one of the things we'll notice is, we're up nicely. We're up almost $10,000 on these positions, ranging from, 3% on AEP, American Electric Power, to 15% on 14% on AT&T. But we have these little blue dots. That means earnings is a coming on all of these. And on AEP and Altria, we have no little chicklet here, meaning we aren't protecting ourselves at all to the downside. And given the current market conditions, is that wise? I would say perhaps we want to reconsider that. Benign neglect can work, okay when the market is really strong. But in times like this, maybe we don't want to count on things just working out. So could we come in here? It's currently trading at 107. When is earnings coming up? May 6th. So what's the advantage of adding a caller now? Well, the advantage of adding a caller now is that volatility is probably a little higher. Now you'll notice, and I just want to draw your attention to, I came out here to S&P 500 sector indices, and we just loaded this list, and I've customized it. We've got description and a 4-week and a 3-month return here. But what has been the strongest sector in the last 3 months? Consumer staples and utilities. What is AEP? It's a utility. And then we've got, what was the stock that we just did an example trade on? Dollar General. And what is Dollar General? Dollar General is a staple. So we're looking for these areas where there is some strength in the market. And we can see here that staples, was up stronger than any other sector today and has been the strongest performer, not only over the last 4 weeks, but over the last 3 months. And utilities have been strong also. They're in the number 2 position. So, when we come and we look at AEP, we bought it on this day here. And again, we saw this kind of inverted head and shoulders pattern. We bought it here. We've got a little bit of a gain on it, but could we sell this 110? A call at 110, would we get enough premium for it to be worth our while? And then maybe come down here and say, hey, if it breaks below this support level, that isn't a good sign. And so we're using the money from the call to protect ourselves to the downside. And we want to come out past where? We want to come out past May 6th. So we're going to come to our trade tab. This only has monthly options. So if we sell the 110 call, we'd get $1.55 to $1.80. And then if we buy a protective put at the 100, that would cost us between 70 and 95. Now we already own the shares of stock, so we don't have to buy stock. We already own it. We're doing this to protect the position. So we're going to come in here and we're looking at selling a caller. Where's our caller? Our caller. So we want to sell the 110 and we want to buy the 100. And we're going to get a credit of 85 cents on that. How many do we want to do? Well, we have 400 shares of stock, so we'd like to do 4 of those. So we're going to put that in. And this is on our dividend stocks. And we can leave that in there. We've just now, we put a cap on how much we can gain, but we've also put a cap on how far, how much we're willing to lose, or put a cap on, a protection at the bottom. Okay, so that's AEP. Now, what about Altria? So, we have a bit of a gain on this one. We paid 55. It's trading now at 58. Could we come in and do something similar, sell the 60? Let's see what the chart looks like. I'm just looking at the chat. Okay. So with Altria, we bought it here. So this was, a diagonal resistance breakout. When I look at it, it's like, why would we have bought it there? And then I'm thinking, oh, because we had a bit of a breakout, or maybe we were looking at this, where it broke out above. But in any event, we got in here, it came back. And if we wanted to put a target on this, we could, or we could just say, you know what, I'm looking, if it comes back up to the 60 and I sell it, I'm okay with that. If it comes back down to this 52.50 level, I'm okay, I would want to exit the position and minimize my loss, but know that I, even if it were to gap down dramatically, that at least I could get out at this 52.50. And so I'm going to change this line here to 60. And this would be where we would put our covered call for May 16th. So we can show that on the right. If you just want to be able to see this on your chart, and then I'm just going to edit this. This is the 52.50, and we're going to call that a protective put, May 16th. So let's just see if these are really viable for us. So if we come out to May 16th, and we look at the 60, we get about 92 to 99 cents. And if you say, well, that's not that much, but this is a $60 stock. So that's about 1.5%. Plus it would be almost $2 more of appreciation in the value of the stock. And then if we came down to the 52.50, it would cost us 28 to 34 cents. So we're going to, again, we're looking at doing a collar where we're selling the call and buying the put for protection. So I'm selling only this. I want to be the 52.50. And you might say like, well, I'd rather it be the 55. I don't want to, have that big a risk. You can make these numbers whatever you want. And if you want to take less risk, you can do that. So we're going to put this in our dividend stock as well. Now, we do have stops on AT&T and Verizon, but given that we're coming into earnings, what some investors will do is they'll have a stop on, but then when earnings is imminent, they may delete that stop and use a protective put instead, because we have a $3,400 gain. And this is an unrealized gain. So what the market giveth, the market can taketh away. And so, maybe we want to come up here to AT&T and say, you know what, I'm going to cancel this stop at $22.89. We bought it for $23.74. We're going to come out and look at the chart. And so we bought it here. And some might have said on that day, well, it gapped up. We got in too late. But, it's moved nicely. It's up 20% year to date. So it's outperforming the S&P by 30% because the S&P is down by 10. So if we look at this again, like, could we sell this 29 call? Or even a 30 call? But if we look at that 29, and then where might we, want to put our put? Maybe, if we want to be in this longer term. So the further away you put your put, the less likely that you're going to need to use it. So if we came down here to 25 and we said, we want to stay in this range if we put our protective put down here. Now you might say, hey, I'm really nervous. I'd rather pay the money and put my put at 27 or, something like that. And it's your choice. But if you're looking at a longer term way of just, protecting yourself, protecting the position, and this would be, May 16th. And when is earnings? Is the 23rd. So we don't even have to go out to May 16th. We could, on the put, well, for AT&T, we have to go out to May 16th because that's the only option available. And so with AT&T, the put at the $25 mark, and look, we've got over 20,000 contracts, so lots of liquidity, 32 cents. If we sold the 29 put, we'd get 29 to 35 cents. So it's kind of a wash. Now you might say, well, I want to be able to participate in the upside. Like, look at the last time it gapped up. So you might say, I don't want to potentially cap my gain. I'm willing, given that I'm up, how much I'm up, I'm up $4 a share. I'm willing to just spend the money for the protection to the downside. And so with this one, let's do something a little different and let's just buy the put and let's not sell the call. So we're just going to buy a put. And how many of them are we buying? Well, how many shares do we have? We have 1,000. So we're going to buy 10 of them. Oh. It's like a short-term policy protection that gives us the right to sell the shares at $25. And what would be our ideal scenario in this case would be if the stock gapped up to 31 or 32 bucks a share and this expired worthless. Because if it gaps up, past 30, we've made $3 a share. And we've said, well, we had our short-term protective policy in place and it expired worthless. And you know what? We're totally okay with that. But if we need it, we're glad we have it. Okay. So that's our dividend stocks. We're putting some protection in place. And we have one more to look at, and that's Verizon. We have 700 shares of Verizon. So let's have a look at Verizon. And we do have a stop in place. Now, if we want to see, we bought it here, and boy, it came way up, came back down, came way up, came back down. It seems to be on its way back up. But what do we have? We have earnings coming up on the 22nd, so kind of right around the corner. And this stock, it has looked like it has gapped down more often on earnings. Well, on this one, kind of came back a little bit and then took off. And so we might want to make sure we protect ourselves, and maybe we're more willing to sell a call on this one, thinking that if earnings reaction might be a little negative, then we could earn a little cheddar by selling that covered call right before earnings. So let me just look at my calendar. When is earnings? The 22nd. Okay, I'm going to be on vacation on the 21st, but I'll try and look at that. Is it before the market opens? It's before the market opens, for crying out loud. Okay, so we're going to come to our trade tab once again. Where do we want our stop? Well, it's come down here a couple of times, so maybe we want to have a protective put around the $41 mark. Let's see, what would that cost us? 38 cents. Or we could do the 42 at 58 to 62. If this is 1% at 41. And then if we sell, it's at 44. Now, if we sell the 45, we could get called out, or if we sell the 46, we have a lot of volume here. That would cover our cost on selling the 41. So, and you may say, well, that's only, a $2 move, but a $2 move on a $46 stock, that's 5%. It's not nothing. And so, like, these are the questions and the conversations you have to have with what I call the divine trilogy, me, myself, and I, that you have to have with yourself. On am I willing to sell this, or do I want to hold it longer term? If you're saying, well, I just want to hold it longer term, but the last three, earnings announcements, it's looked like it's had more of a negative impact before it rallied. So maybe I could take advantage of that. And right after earnings, if it goes down, I could buy this back and make a little money. But just because it went down the last three times doesn't mean it might not bounce up this time. I did a trade on UNH years ago. And the last three earnings announcement, it had gone up pretty dramatically. And so I sold an option, and then it tanked on the fourth earnings announcement, the one that I had bought, that I had sold that. It was something called the short put vertical, so, that past history doesn't guarantee future results. So this is, and I'm just kind of sharing this stream of consciousness so, that you understand how a trader, might, we don't want to do covered stock, how a trader might think about this stuff. So we are here selling a collar again. And so we're going to sell the 46, $2 above where it closed today. And then we're going to buy that put at 42. And so, for that, it's currently saying, well, that'll cost you 4 cents. Yeah, we're willing to pay it. Okay. And how many shares do we have of Verizon? 700. So we're going to do 7 of these. Oh, and you know what? Let's see if I can come back to the monitor tab, because we have an exit on Verizon at 39.58. So we've essentially moved our exit up to 42, right? But we have to cancel this. So I'm going to cancel that order. Otherwise, the other order won't go in. So we had a stop in place. Now we're buying a protective put, which will give us the right to sell it at 42 if we so choose. Confirm and send. And we're going to put that in our dividend bucket. Does this make sense to everyone? Yeah, so if you call Schwab, Michael is saying, how do we get this app so we can see the same thing? Because the web version is totally different. And you are right, it certainly is. So if you call Schwab's 1-800 number, they can walk you through how to download the Thinkorswim desktop version of the platform. When the collar expires and you still hold the stock, are you buying another collar? Oh, Josh, okay, I'll pay you later, honey. Because we just looked at 4 trades that we have on where we didn't have collars, right? Why does this say buy it? Oh, because we were doing that one differently. Now let's come down, because we had a whole bunch of collars. And one of the things I did, I looked at Hershey, and Hershey had a put that was expiring today. And let's go up and look at this. Hershey. So Hershey, we bought the stock at 100 shares at 182. We sold a covered call at 370, and then we bought a protective put at 177. We did all of this on March 7th. On April 4th, Hershey's had started to pull back, so we decided to take our profit on the call, and we bought back the call for 27. Today, the stock, well, let's see where it closed. The stock was trading below 170. I think it was trading at 166.03 when I did this. So let's go look. So here was this trade. We put it on this day. It went up above our covered call price. We were, we'll never be called out. This is another difference between paper money and a live account. You'll never be called out early on in paper money. It can happen in a live account. It doesn't happen that often, but it can. So we bought back the covered call, so that was no longer on. But this protective put was expiring today. Now, if it expires in the money, so in other words, below here, when we buy a protective put, and it's saying that we have the right to sell the stock at 170. If it is in the money at expiration, probability is very, very high that this will be exercised. But I went ahead and exercised my right to sell it today. And I couldn't do it after the close because it wouldn't have gone through and it would have expired. And how did I do that? So this is what it shows like. I exercised my right to sell the stock at 170. So I sold it at $4, basically above where it was currently trading. Okay. Now, how would I do that? Well, let me show you. So if you come back to activities and positions, if we come out to Kroger, well, we have the call and the put. So what you would do is highlight, if I wanted to exercise my right to sell the stock at $65, and I wouldn't want to do that because it's trading at 71. But if I wanted to do that, there's a tab here that says exercise, and you just click on that and say, okay, I want to sell my shares at 65. We don't want to do that with Kroger. So if we look at our position on Kroger, so here's Kroger. We have our covered call up here at 75. We have our protective put down here. They both expire May 16th. We bought it on this day, and then it pulled back, came back down to this support level, and then has rallied it and is moving on up. Again, notice what category are we in here? What sector? Consumer staples. So if we do have that demand destruction, well, people may be buying ground beef instead of a sirloin or a filet mignon, but chances are they're still eating. They're still buying groceries. Where as opposed to Restoration Hardware, more of a luxury good, we can see that stock is not doing so well. Okay. So that's Kroger. So no action required on this. It doesn't expire until the 16th. And so we're just going to let it, percolate. We also had a position have a position on Coca-Cola. And we did the same thing. Notice a trend here. So we want to participate in areas of strength, but we're doing so, with caution. Like we have got our helmet on, we've got our shin guards on, we've got our elbow pads on. And what we call that in the world of trading is a collar. So we bought it here. We bought a protective put. And had this been expiring on this day, we might have chosen, to exercise our right to sell. But right now it's sitting kind of right in the middle of the pack. We still have a couple of weeks to go. We have earnings coming up on the 29th. So if it gapped up, could we end up called out? And our covered call, I think, is at 75 on Coke. Yeah, it's at 75. I just didn't tidy up my thing here. So we're going to let that just percolate. Okay. Who else do we have in here? Well, Hershey we've talked about. Kroger we've talked about. The last one is Mickey D's or McDonald's. So we bought the 300 put and that expired today and it was worthless. And so we just let it expire. We still have this 325 call on. Interesting. And where's the stock sitting? At 311. And how much have we made on that? $387. So if we're bullish on McDonald's and think it might continue to go up, maybe we take that 50% gain, and then if it continues to go up, we could have, had I not been wherever I was, we may have closed out this covered call down here and we would have seen a bigger gain, but could we buy it back for that 50% gain and then sell another one when it comes back up to the 320 neighborhood? We could. So, we don't have to wait till it expires. We could say, you know what? We'd like to buy back this covered call. And so, and maybe, it's going to be a long weekend and 3 days of time decay. Let's see if we can buy it back for 325. And why am I saying that? Well, if we look at time decay, so let's bring back our data. What this is saying is it's going down in value by 13 cents a day in the next 3 days. So that's 39 cents. So if I take this 39 cents off this, maybe we could buy it back for 320 or 310 come Monday. So we're going to come back here. We've got our position with our closing order and say, yeah, let's see if we can buy it back for 310 come Monday. And that's why I picked that price. But we're going to look at this when the market's open on Monday, right? Right. So we've actually covered a lot of ground here. So we put on a new trade on Dollar General where we collared it. So we bought the stock, sold a covered call, and bought a protective put. We then looked at 4 positions that were already in our portfolio, and we added callers. To 3 of them we added a collar, and to 1 of them we added a protective put, because we are battening down the hatches, my friends. We do not want to snatch defeat from the jaws of victory. We know things can move dramatically when earnings happen. And so we are cautiously optimistic, which is different than hope. Hope is a 4-letter word in the land of trading. We don't, structure our investment decisions around hope. We're cautiously optimistic. If we weren't cautiously optimistic, what would we do? We'd liquidate all these positions and say, thank you very much for this $10,000 gain. And now I'm going to, invest in CDs or something like that until things come around. So we're cautiously optimistic, but we're not counting on it. So we've still got the helmet and the shin guards and the elbow pads on. Okay. And I've got Ski Patrol on speed dial. And then so we looked at those 4 positions, and then we looked at several collar positions that we had on, and we made some management decisions on those as well. So guys, that's what I had to share with you today. If you haven't hit the like button, if you could hit that before you sign off, I'd really appreciate it. It helps move this up in the algorithm so more people can find this content. If you could also click on that link, the survey, it'll take you 20 seconds, my friends. It's 2 questions. 1 was, geez, I hated this. 10 was, I loved it and I'm going to keep coming back, and everything in between. And then you can put comments in. If there's topics you'd like us to discuss in upcoming classes, let Mike and I know. And we'll certainly, I promise to read each and every comment. So will our management team. Last but not least, follow us in the land of X. Mike Fairborn CS, Barb Armstrong CS. Have a really wonderful Easter if you celebrate that holiday, and get out there and hug someone you love, no matter what holidays you celebrate. And I will see you next week. So take care, everyone. Bye for now.